webinar, and it's good to see that we have a good turnaround of participants on this webinar. I am Darvana Sarmatkar, a Strategy and Business Development Manager at MI Capital Services. MI Capital comprises of a team of experts who work together to serve client on a board of a range of advisory services. On the next slide, you'll see our team has 250 plus years of combined experience. We have arranged $350 million of funding, done 250 plus valuations, due diligence, and modeling projects. 7 plus chartered accountants are there in the firm with 150 plus years of combined experience. We have done 200 plus real estate financial modeling, also formed 100 plus new companies. Here, on the next slide, you'll see our board of directors who have extensive experience across several industries. Uh, following slides, you will see our team who comprises of 30 plus members who are experienced in their respective fields and serve clients to a broad spectrum of advisory services. We have a track record of successfully delivering solutions in a diversified market spectrum, basically. Um, Today, in this session, we'll broadly cover the introduction of corporate tax in the UAE, along with its impact, process, and implication on the business in the UAE. Uh, Let me introduce you to the first presenter, Mr. Sheetal Soni. He is CFA chartered holder with 20 plus years of experience in areas such as capital raising, valuation, mergers and acquisition projects, and corporate financing funding. I'll hand over to Mr. Sheetal Soni, who is also the founder of MI Capital Services. Over to you, sir.
Thank you, Darpana. Thank you very much. Very good evening and warm welcome to you all on our webinar, Simplifying the UAE Corporate Taxation. At the onset, I would like to thank you for your vital time for attending this webinar. Ever since the UAE announced corporate taxation to be applicable within the country, people have been waiting for the federal law. On 9th December 2022, UAE Ministry of Finance published the corporate tax law, which will be effective from financial years starting on or after 1st June 23. This follows the public consultation document released on 28th of April 22, which described the main features of the planned CT regime, as well as the principle applied for the corporate tax regime. The wait is over now, and MI Capital Services team is here to simplify the corporate tax law for you. I don't know if Albert Einstein really said this or not, or it is just a WhatsApp meme. In any case, tax laws are never easy and simple. We have tried to simplify the interpretation of the tax law as much as we can for your better understanding. I am in UAE for close to 2 decades, and we all got used to 0% tax and almost nominal compliance requirements in this country. UAE has long enjoyed tax-free status, which started to change since 2018, when UAE introduced indirect taxes in the name of VAT. Introduction of corporate tax is a big change and reform that will impact how we all conduct business in this country. If we were not aware how much we should be thankful to this amazing country, now we know with the tax rate in place. The introduction of federal corporate tax regime is intended to help the UAE achieve its strategic objectives and accelerates its development and transformation. The certainty of competitive tax regime that adheres to international standards, together with UAE's extensive network of double taxation treaties, will further cement UAE position as a leading jurisdiction for doing business and investments. The introduction of law now officially changes UAE status from no corporate tax jurisdiction to a low corporate tax jurisdiction. The chart that you see on the slide shows that there are a handful of jurisdictions having tax rate lower than 15 to 20%, whilst the UAE tax rate is 9% in comparison. Given the position of UAE as an international business hub and global finance center, the proposed UAE corporate tax regime has been built from best practices globally and incorporate principles that are internationally known and accepted. This ensures that the UAE regime will be readily understood rather than introducing new concepts that would need to be evaluated by the investors. Now, let me take you to certain salient features of this corporate tax law. First and foremost, up to income of 375,000 dirhams, the tax rate has been kept at 0%. Over and above 375%, the 375,000, 9% tax will be applicable. Global income of UAE entities will fall under the purview of corporate tax, however, subject to certain exceptions and reliefs, which we will cover during the course of our presentation. There are some special concessions to qualifying free zones, which we will also discuss during the course of the presentation, subject to satisfaction of certain conditions. As the name suggests, it is a tax on corporations and businesses, not on individuals, for example, salaries. Further, no taxation on personal investment income in the hands of individuals will be applied, which is, for example, rental income, dividend income, debt and equity income from debt and equity securities. Again, corporate tax is not levied on capital gains earned in the hands of individuals. Withholding tax so far has been kept at 0% for the time being. Further, there are provisions of tax grouping, carry forwarding of prior year losses based on globally accepted taxation principles. The law will be effective from 1st of June 2023 and applicable for financial years of the businesses starting on or after 1st June of 2023. So these were the basic salient features. Now my two bright and young colleagues, Pratik and Karishma, will be taking us through various important topics of the law in detail. During the course of our presentation, we'll conduct some quick polls and try to make it interactive, which we hope will help answer some of the burning questions you may have in your mind during the course of the presentation. If you still have some queries, please do write the same in the chat box and we'll try to answer them and take as much as we can towards the end of the presentation. Darpana, over to you.
Thank you, sir. That was really great. Let me introduce you guys to Miss Karishma Suvarnakar, who is the head of the Accounting, Tax and Compliance Department here at MI Capital Services. She is also a specialist in auditing and indirect taxation. Karishma, over to you.
Thank you so much, Darpana. And thank you, Sheetal sir, for a quick gist of the law. Let me now just quickly explain the topics as displayed on the screen one by one to have a detailed understanding about what does each and every topic mean in the corporate tax regime in a very simplified manner. To begin with, let me start with the taxable persons. Now, under the UAE corporate tax regime, taxable persons can be either the resident person, a non-resident person, and a branch of a resident person will also be considered as a taxable person. For a resident person to be considered as a taxable person, three categories have been further explained, which means a juridical person which is incorporated or established in the UAE, even which is established in the free zone entity, will be considered as a resident person. Secondly, a juridical person which is in the foreign jurisdiction but which is effectively managed and controlled in the UAE will also be considered as a resident person. And lastly, any natural person who is conducting the business or business activity will be considered as a resident person. Now, for the resident person, the global income will be taxable under the UAE corporate tax regime. For a non-resident person, let me tell you that a non-resident person who is having a permanent establishment in the state or who has a state-sourced income within the state, then the taxable income of the permanent establishment of that non-resident will be taxable under the UAE corporate tax regime. Also, the state-sourced income which is not derived by the permanent establishment of such non-resident will also be taxable, and any taxable income which has any nexus of such non-resident persons within the state will also be taxable under the corporate tax regime. Now, with this definition, there are certain other definitions which need to be explained and which need to have an understanding for getting an idea that what will be a taxable person's criteria. Very first, as I mentioned, that a juridical person having established in the UAE or effectively managed and controlled within the UAE will be taxable. So, what is a juridical person? Any entity that is established or recognized and that has a separate legal personality that is different from its founders, owners, or directors will be considered as a juridical person. Secondly, they have mentioned that any taxable person who is conducting a business and business activities will be considered as a taxable person. So, what is a business and business activity? Now, business can be a wide definition, and as explained in the law, it states that any activity that is conducted regularly by any person, it might be in location in relation to industrial, commercial, agricultural, professional, or any other activities that is being considered for tangible and intangible properties will come within the definition of business and business activities. And if such business and business activities are conducted within the state, then it will come under the corporate tax regime. Now, as I mentioned, that a non-resident person who is having a permanent establishment and a state-sourced income within the UAE will be considered as a taxable income of that non-resident person. So, what is a permanent establishment? So, let me tell you that permanent establishment can be defined as whenever any entity of a non-resident is controlled effectively and management from the country from the UAE, then it will be considered as a permanent establishment of that person is having an effective substance in the country. Now, what can be considered as an effective substance has not yet been defined, but we hopefully expect it will be further defined in the executive regulations. Further to the permanent establishment, they have even said that there cannot be a fixed or permanent establishment of a non-resident when any person in the UAE is only acting as an agent or contractor or any intermediary just for storing the goods or any other likewise for the non-resident person to a state-sourced income. Now, what is a state-sourced income for a non-resident person? Whenever any income is derived from a resident person by a non-resident person, it will be considered as a state-sourced income. Other than that, whenever an income is derived from a non-resident, but that non-resident has a permanent establishment in the state, then that income will also be considered as a state source income. And any income that is derived from the activities performed or assets located or capital invested or rights used and services performed that are benefited within the state will come under the state source income. The law has defined certain illustrative list about what can be considered as a state sourced income. In short, to give a gist about the taxable persons, it can be said in a nutshell that any income that is derived within the country or that is derived in the UAE will come under the purview of corporate tax regime. Now, with the taxable persons come another definitions, that is exempt persons. Let me tell you that exempt persons has been defined as any person who is a government or government controlled entity or a qualifying public benefit entity, a qualifying investment fund, a public pension or a private fund or social security fund subject to certain conditions, and any person who is engaged in an extractive or non-extractive business of natural resources that also subject to certain conditions will be considered as an exempt persons. Now, with this exempt person, I would like to elaborate each and every category to have a detailed analysis of taxability on these exempt person category. Very first, the government and government control entities. Now we all are aware that government and government control entities are on international level being kept out of the purview of any taxation. But it has been also specified in the UAE corporate tax law that any business or business activity, if any conducted by the government and government control entities, it will be subject to corporate tax. Now, if the government and government control entities are conducting any such business activity, they need to maintain a separate financials for such business and business activities, and that will be treated as the independent business. Also, they have to make a separate calculation of the taxable income independently for each such period when they are having the business other than the exempt business. Wherever there is a transaction between the business and the other activities of the government entity, this is considered as a related party transactions and they are subject to arm's length principles. The arm's length principles and related party transactions will be further explained by Mr. Pratik in the webinar. The government and government entities may apply to the authority for all its business and business activities to be treated as a single taxable person. But once it is being applied, they have to continue until and unless there is any change or modification to their application. The next important exempt category is non-extractive and non-extractive business of natural resources. Now, as we all are aware that the extraction and non-extraction business of natural resources is subject to an emirate level taxation, which means they are already levied a taxation at emirates level. If they are again taxed under the corporate tax regime, that will levy a double tax. Hence, this category of business has been specifically kept out of the purview of corporate tax. Now, to be exempt, if the person directly or indirectly holds or has an interest in the right, concession, or license issued by the government to undertake such extractive business and is effectively subject to tax under the applicable legislation of an emirate and has made a notification to the ministry in the form and manner agreed by the local government, then this category of extraction and non-extraction business will be not subject to corporate tax and be an exempt category. It may sometimes happen that along with the extractive and non-extractive business, there is some other business as well as defined in the earlier slides. And if such business are earning that income as well, and the revenue from such business exceeds 5% of the total revenue, then that will be taxable under the UAE corporate tax regime. However, if that revenue is less than or equal to 5% of total revenue, then it will be taxed as per the legislation of the emirate and it will be taxable under that tax category and not under the UAE corporate tax. Any common expenditure that is being shared between the extractive, non-extractive business of natural resources and the other business, then it should be apportioned on the revenue proportion between these two businesses. There are some other conditions and factors that an extractive or non-extractive business has to be mindful of. Very first, any transaction between the extractive business and the non-extractive business and other business category will be treated as a related party transaction and it will be subject to transfer pricing rules. Notably, the extraction and non-extraction business exemption does not continue to the contractors, subcontractors, or other persons who are in performance of extractive or non-extractive business. That is, this category of contractors and subcontractors will be taxable until and unless they meet the exemption criteria as defined. Now, let me take you to another important exemption, that is a qualifying public benefit entity and a qualifying investment fund. Now, whenever a qualifying public entity is established or operated exclusively for religious, charitable, scientific, cultural, or similar purposes, then it will be considered as an exempt category. Also, if it is established as a professional entity or chamber of commerce or similar entity operated exclusively for the promotion of social welfare or public fund, then also it will qualify for exemption. Also, the public benefit entity does not conduct any business or business activity other than directly related to their exempt category or their religious, charitable, or scientific, etc. purposes. Income or assets used in the public benefit entity are used exclusively for the furtherance of the purpose of the religious, charitable, or environmental, etc. activities. The assets are not used for the benefit of the shareholder, the member, trustee, founder, or settler of such public benefit entity. The another important criteria is qualifying investment fund. Now, as we all are aware, fund is a burning legal personality that has been come into existence in quite some time in the UAE. Now, qualifying investment fund has been kept exempt under the purview of the corporate tax regime, but subject to certain conditions. The conditions are, very first, the fund or the fund manager is by the regulatory authority within the state, even the foreign competent authority, if they are regulated under that, then also they can claim the exemption. Any interest in investment fund is traded on the recognized stock exchange, marketed and is widely available to trade, then also they can claim the exemption. And lastly, the qualifying investment fund is not set up for any is not set up just to avoid the corporate tax. If these all conditions are met, then the qualifying investment fund will be exempt from the corporate tax regime. Now, it may happen sometimes that the authority may request for the relevant information or records time to time based on that analysis to verify that these categories are exempt categories. Now, let me introduce you about the partnerships. Partnerships has always been a subtle way of doing business in the UAE or worldwide to avoid heavy compliances or complications. There are three categories of partnerships. Very first, unincorporated partnerships, incorporated partnerships, and foreign partnerships. Now, unincorporated partnerships are those partnerships where the people are being established and having any contract between them, and that is not yet been legalized. So whenever a partnership is being established, unincorporated partnerships is established, it is not treated as a separate taxable person unless an application is made to the authority to be treated them as taxable person. In such case, the individual partners will be treated as taxable persons and the corporate tax will be applicable on those individual partners instead of on the unincorporated partnerships. Likewise, if the unincorporated partnerships applies to be a taxable person, then the partnership will be taxable and each and every partner will be jointly and severally liable for corporate tax payable on them. Unincorporated partnerships will by default be treated as a taxable person and they have to file the returns accordingly. The third category of partnerships which comes into picture is the foreign partnerships. Now, generally, foreign partnerships are treated as unincorporated partnerships, and the similar regulations will be applicable on any unincorporated partnerships within the state. If but there are certain conditions for the foreign partnerships. It is that they are not subject to tax in the foreign jurisdiction in which they are set up, and each partner is individually subject to tax on the distributive income they are earning from such partnerships and any other conditions as may be prescribed with the executive regulations. The burning question about the family foundation. Now, let me tell you that family foundation has been a family foundation has been often playing a similar role of trust, especially when it comes to holding or protecting the assets and the legacy planning. Now, most importantly, the foundation is an independent legal entity holding assets in its own rights. The foundation meets the wealth protection needs, but it also retains a separate legal entity. Under the UAE corporate tax regime, family foundation is being treated as unincorporated partnerships, and all the laws and regulations and the conditions as explained in the previous slide will continue for the family foundation as well, but subject to meeting certain conditions. Very first, the family foundation is established for the benefit of the identified natural person or the benefit of the public benefit entity. The principal activity of the family foundation is to receive, hold, invest, distribute, manage assets or funds associated with savings or investment. The family foundation does not conduct any activity considered as business or business activity. And the main objective of the family foundation is not to avoid the corporate tax. If all these conditions are satisfied, then it will be treated as unincorporated partnerships and no corporate tax will be levied on them. Moving on to the free zones. Now, free zones has always been given a special exemption under the UAE, and all people are aware that they are also being given tax holidays up to 50 years in the UAE. The UAE corporate tax regimes will continue to give such benefits to the free zones, but it has given certain exemptions and certain conditions which need to be satisfied to be eligible for the 0% corporate tax. Now, under the UAE corporate tax regime, they have said that a free zones need to be a qualifying free zone person to get the benefit of 0% taxation. Now, what is a qualifying free zone person? A qualifying free zone person is anyone who maintains adequate substance in the state. Now, what is adequate substance? Again, that has not yet been defined in the law. Secondly, it has said that a qualifying free zone person derives a qualifying income as per the cabinet decision. Qualifying income again has not yet been defined in the law, which we still await. And the main two conditions which are be given for the qualifying free zone person, that is adequate substance and qualifying income, is the main thing that is not yet defined in the law. Thirdly, they have said a qualifying free zone person need to comply with the transfer pricing rules and they need to maintain the transfer pricing documentation. And they have not made application to be subject to corporate tax in full. If all these conditions are met, then the free zone will be considered as a qualifying free zone, and the qualifying free zone person will be levied 0% tax on its qualifying income, and any other income other than qualifying income will be taxable at 9%. There are certain things that a free zone has to be mindful of. Very first, all the free zone entities are required to register themselves and file a corporate tax return irrespective of their status of a qualifying free zone person, which means even if the business is having a threshold of less than 375,000 dirhams for the net profit, still they have to get registered and file a corporate tax return, which even might be a nil return. If a free zone person are a part of large multinational group, then they will be subject to pillar 2 rules of the OECD, which has not yet been embedded in the law. Very soon we expecting the executive regulations that also will be defined. Now, as free zone persons are given a tax holiday period that will continue which is already been granted to all the free zones. Each free zones has a different tax holiday periods that will continue to be levied to them, but maximum up to 50 years. Last but not the least, the another important category of exempt persons is the holding and the branch companies. Now, what happens is branch is not having a separate juridical person identity within the state. Thus, as they are not a separate juridical person, they need not register themselves as a taxable person. Their income will be included in the taxable income of their parent or head office. Also, they need not file a separate corporate tax return for the same. Now, income of foreign branches or permanent establishment of the UAE business that is included in the taxable income and the corporate tax return of their UAE head office, unless the UAE business elects to claim an exemption from its foreign branch profits. A UAE branch of a foreign business will be subject to corporate tax unless the activities of the branch do not give rise to permanent establishment in the UAE for the corporate tax purpose. Lastly, the holding companies. Now, holding companies are treated as a separate juridical person and hence they are subject to UAE corporate tax. Taxability on the holding companies will be based on the jurisdiction in which they are located. If they are located in mainland, they will be taxed at 9% of their global income. And if they are registered in free zone, they will be taxed at 0%, subject to the free zone conditions as I explained earlier. Now, dividends and capital gains that are being earned from the domestic or foreign jurisdiction would also be exempt for the holding companies, although the foreign shareholding dividend and capital gains that are being earned, they might be subject to conditions which will be explained in the further in this webinar by Mr. Pratik. With this, I would really like to thank for your patience for understanding and giving time for understanding what is a taxable person and exempt income. I hope this clarifies the things. I know it might be a little bit of heavy dose for the category that I explained. Let us lighten up some mood, and I would really request Darpana and Sheetal sir to take over the charge and have some poll questions. I would really request all the audience to have an active participation in the poll questions that we will be asking here. Over to you, Darpan and Sheetal sir. Thank you so much.
Thank you, Karishma. Very swift, extremely fast. Even I was feeling little difficult to keep pace of the information that you already shared in those quick minutes. But however, next 10 minutes we will have some poll questions which will clarify a lot of the points which Karishma has just covered. Darpana, can we launch the polls? And I encourage everyone to participate in it and we'll discuss about these questions.
Yes. Yeah, here is the first one for all of you on your screen now.
I see one of our guests, Payman, in the panel. He's interested in probably one question. But let's take the first poll. Who all will be subject to UECT? Mainland entity only, free zone entities only, both mainland and free zone entities with few exceptions. What is the understanding that so far we have on this front? May I request everybody to participate in the poll and try to answer this?
It is fascinating to know that 26 people have responded and 92% is going towards both mainland and free zone entities.
Yeah, people are still responding. So yeah,
Yes.
33 responses only out of 150 plus
150.
people. Fifty responses, 96. The public opinion goes towards everyone will be taxable.
Correct.
98%. There are still few people who are still thinking. Yeah. Okay, I think the public opinion is already very clear and the answer is right as well. Both mainland entities and free zone entities fall under the purview of corporate taxation. However, certain free zone entities, which in the law it is described as qualified free zone, and their qualifying income will be outside the purview of corporate taxation. They will be exempt. And however, the law has not yet clarified what is the qualified free zone and what is the qualified income. So we will have to wait for executive regulations before we get to know what exactly might be out of the purview of the corporate tax. So, but yes, however, there are certain exemptions to qualifying free zones earning qualifying income. So I think this poll has been the very good poll. Darpana, can we go to the next poll, please?
Yes. Second one should be on the screen now.
Yeah. Will UAE corporate tax be applicable on individuals? What do you all think? No and yes, only if individual is doing business without incorporated entity. Even if it is doing business without incorporating any entity. Can we try to answer this? Wow, this is better. 73-27, 51 responses. Yes, I think the understanding is correct that normally the individuals will not be subject to tax. However, if individual is carrying a business, irrespective of whether he has opened a company or without any company, that business income will be part of the will be under the preview of UE corporate taxation. So far we are doing good. Darpana, can we go to the next one? The understanding so far looks very good from our audience. Okay, this is this could be, some of the clients may have this as well. I have an investment company in foreign jurisdiction, say Cayman or Seychelles, which I manage and control from UAE. Will UAE corporate tax be applicable on this company as well? Can you try to answer this? Wow. It seems that many chartered accountants are part of this webinar. We are getting all answers correct. Yeah, I think this is the right answer. Normally, a foreign company will not fall under the UE corporate taxation. However, law says that if the entity is managed and controlled from UAE, then it will be subject to UAE corporate tax as well. and the managing and control will be defined through certain conditions, and those tests needs to be seen whether the management and control test is applicable or not. Can we go to the next one? Yeah, this is an interesting question. We see a lot of people, a lot of our clients interested in opening up family foundations. So if you have a family foundation registered in DIFC ADGM, is this foundation subject to UAE corporate tax? And I have deliberately kept the answers as yes, no, and both yes and no. Again, audience are quite aware of the law, it seems. Yes, the answer is yes and no. Why? Foundations are by default preview under the preview of corporate taxation. However, foundations can apply to FTA for being exempt from the corporate taxation if they are only working as a pass-through entity and they are not conducting any business. They are only for holding assets and businesses. In that case, the authorities may give them exemption from the corporate taxation, but for that they have to apply for being not under the preview of corporate taxation. And can we go to the next one? Okay. Will individual be subject to UECT on my income from personal investments, which is dividends, interest on bank deposit, rental income from properties? This was simple. 100%, 98%. Excellent. So individuals are out of the preview of corporate taxation. So this is right. Can we go to the next one? Yeah, this is very important question. Some of our clients do have funds registered in DIFC or ADGM. So the question is, will our DIFC ADGM registered fund be taxable under UAE regime? Yes, no, no, if certain conditions are met. %88. So far, our audience has been absolutely right. Yes, the funds registered in these jurisdictions can apply for exemption, but they have to apply again, same like foundations and meeting certain conditions. Go to the next one. Darpana, can you launch the next one?
Yeah, it's launching.
Will dividend income from UAE entities be taxed in the hands of companies? So if you have an entity who is receiving dividend income from UAE entities, do you think it will be taxed? %23% still feels that it will be taxed. See, globally, dividend income, now we are getting better. 16% still thinks. 10%. Okay. Yeah, so globally, in order to avoid double taxation, dividend income comes after a company earned a profit, paid tax, and then distribute the dividends. So globally accepted principle says dividends normally are not taxed, and that's what in UAE as well. So dividend income from UAE entities will not be taxed. Go to the next one. Will dividend income from foreign entities be taxed in the hands of companies? This is a tricky question. This is a tricky question. Still, our audience is very smart. Yes, dividend income from foreign entities will be taxed. However, they will be exempt. So there will be certain conditions under which they can be, there are certain reliefs and exemptions related to that as well. I think we go to the next one. Yeah, I am a foreign individual and earn investment income in UAE. However, I don't do any business activity in UAE. Will I be subject to UAE CT? Lot of investors in UAE are foreign residents and foreigners, and they make investments in UAE in properties, in other securities also. Do you think it will be taxable? Their income will be taxable. Perfect. Still 4% feels that it might be taxable, but it will not be taxable because it is not a business income. Only business income will be taxed, not the investment related income in the hand of individuals. So far, all our questions, Karishma, though you were fast, people were quite attentive. The next one, will contractors servicing oil and gas sector or any other extractive industries which are exempt from UACT be taxed under the UACT law? Yes or no? Wow, this is a kind of close to tie. This is the first question we are probably getting a wrong answer.
Wrong answer. Yes.
52 responses. 58% are saying no. Since there are certain businesses which are kept out of the, which are in exempt categories like government controlled entities, government owned entities, certain companies in extractive business, but the contractors of these companies who are doing contracting work, who are doing subcontracting work, they will fall under the purview of UAE corporate taxation. So the correct answer is yes, unfortunately. Let's move on to the next one. Will tax holidays continue to apply for free zone entities under UACT law? Yes, no, or yes, subject to certain conditions. Yeah, that was straightforward. Qualifying free zones, qualifying income will be exempt, will continue to exempt, but this exemption is up to 50 years or whatever free zone authority has promised. To that extent, it will remain available. It will be out of the purview of corporate taxation. I think this understanding is very clear as far as our guests are concerned. Next one.
Yeah, that was all for now. Thank you so much for selecting your options and submitting it. It was really interactive. And over to the third and the last presenter for the day, Mr. Pratik Toshniwal, sorry for that. He is a chartered accountant with specialization in mergers and acquisition and domestic. He's a domestic and international tax advisory, also specialist in restructuring advisory. So over to Mr. Prateek.
Thank you, Darpana. Thank you so much, Sheetal and Karishma, for an interactive session. I think the audience is enjoying it for sure. And I would just request Darpana and Karishma to keep a track of questions because the chat box is full with the questions. So moving ahead with about calculation of your income tax, the tax that is going to be applicable. So Karishma, if we can move to the next slide, what is important for people to know is their calculation. Karishma, unfortunately, the slides are.
Let me reshare again.
Yeah.
I'll do it.
But I hope a lot of the queries would have been solved till now. And I'm very confident that over the time, if there are any more questions or detailed queries that is required, will be answered. Thank you so much, Karishma. So as I said, what are my tax figures? What is my tax that I have to pay in UAE? So as mentioned by Sheetal and Karishma, UAE stands out in terms of calculation of taxes because it is very simple compared to the global scenario. And in the next slide, I will show it to you the 6-7 adjustments that has to be done. Very clearly, what has to be done in this is the adjustments related to unrealized gain and losses on the capital and revenue stream. I will touch upon what are these factors in the later slide. Just quickly, how the exempt income has to be treated, how the non-deductible expenses has to be treated, what are the transfer pricing applications and where will the adjustments be made on the transfer pricing applications, what will be the effect of losses and the foreign tax credit. To start with, what is very important to understand is you may have your house in Palm and that value of the house would be 10 million, for example. If you feel that in the present year, the asset is valued at 8 million, that means you have an unrealized loss of 2 million, which depending on the scenario of the management, can take a call to adjust the same unrealized loss against the income. However, if in the next year that house was sold at 11 million, the difference will be added back to your income for calculation. So this is not a compulsory clause, but an elective clause, which each taxpayer would have to take into consideration. What also will be adjusted apart from this will be the exempt income. What is the exempt income? Dividends, capital gains that you receive from foreign jurisdiction meeting the criteria of participating interest. For participating interest, 3 major conditions have to be qualified. You would have to have more than 5% or equivalent to 5% of the holdings in the foreign jurisdiction company. That has to be maintained uninterruptedly for 12 months. And what is also important is the jurisdiction where this holding is available. That has to be above or equivalent to 9% of corporate tax. If these conditions are met, your dividend and capital gain will be exempt even from the foreign jurisdiction. However, capital gains on sale of shares and dividends from local entities will be exempt by virtue of the law. Also, non-residents operating in the leasing of ship, on the leasing of aircrafts will be considered as exempt income. Going forward to understand what are the reliefs that has been given, there are two major reliefs when it comes to losses. One is transfer within the qualifying group for which several conditions, majorly 75% of the holding has to be maintained, and a business restructuring relief where your part of the business or the entire business is transferred. However, it has to be transferred at the net realizable value. Then only the relief will be provided. If it is not, and if it is done at a market value, corporate tax will be applicable. Moving ahead to understand whether your expenses relating to chocolates, ice creams, meals done for the business will be exempt or not, or will be allowed as a deductible expense or not. To understand the clause of deductible and non-deductible expenses, you need to categorize yourself very simply. If it is done for business and business growth, it is absolutely deductible. But any fines, any breaches, any bribes, any donations, any corporate tax paid, any input VAT paid, that is the revocable VAT paid, will not be allowed as deductions. Also, it is very, very important to understand that any expense not incurred for business has to be separately treated and will not be deductible. Last but not the least, 50% of your entertainment expenses, like I was mentioning about the chocolates, ice creams, the meals, wining and dining, accommodation, transportation, all of this will be restricted to 50% of the non-deductible expenses. After this, there are few heavy and most important topics that I would want to cover for the businesses specifically. One is the interest capping rule, which is also known as the thin capitalization rule. And this is done to meet the global standards. What is allowed is the interest expenditure, which is capped at 30% of your EBITDA. Any expenditure of interest that will be incurred, say $100 in the year has been incurred on your interest. If your EBITDA is 100, this year, the interest that will be allowed will be 30, 70. Fortunately, because UAE corporate tax law is very, very favorable for the people, it will be allowed to be carried forward for the next 10 tax periods. But the capping remains the same of 30% of the EBITDA. What is not allowed as deduction in interest is, say you have an entity in Seychelles, which is a tax-free jurisdiction or a low tax jurisdiction. If there is any loan that has been borrowed for payments of dividends, for capital contribution, and if there is any interest that you're paying on that, it will not be allowed as deduction. However, for jurisdictions where the tax is higher than 9%, there needs a lot more clarity, which will be announced soon. Going forward, what is very important to understand and what I was discussing about was transfer pricing rules. It is applicable for individuals, it is applicable for juridical persons, and it is applicable for related and connected person. Related party definition is very, very wide. It includes all the 4 degrees of kinship, which includes great grandparents, great great grandparents, and your first cousins, your uncle, aunt, your parents' uncle, aunt. So it is a very wide definition, and you need to be very careful while identifying whether they are related party or not. Also, the controlling ownership has to be over and above 50%. The most interesting factor and the affecting factor for the businesses will be the definition of connected persons. Owner of a taxable person or a director of a company or a business, if they are drawing any remuneration, any fees, if it is not at the arm's length price, it will be subject to transfer pricing adjustments. Transfer pricing has, there are 5 methods which has been prescribed. However, there may be industries where these 5 methods may not be applicable. With an application, you can always use any other method which is the best suited for your industry and has to be followed. But at the end, what is important is to make sure that any transaction done is at arm's length principle. Moving ahead to the tax losses, to understand it, it is very, very clear that business tax losses can be carried forward for indefinite period. Again, as I said, UAE corporate tax is very friendly, so it allows it to be carried for indefinite period. 75%, only up to 75% of your taxable income. Say you have a carry forward loss of 100 dirhams this year, and next year your income is 100 dirhams, you will be allowed only 75% of that income to be taken care of. The balance 25 will have to be carried forward. There are two conditions that has to be met. Obviously, the 75% criteria and the shareholding has to be maintained 50% or above. If there is any change in the shareholding lesser than this, there has to be seen whether the individual or the company who's changing the shareholding was related or not. So that is an aspect that will be considered. However, no tax losses will be given for period ending December 2023 for the activities or assets which is exempt from a UAE corporate tax law perspective. Now talking about the tax grouping. Lot of entities in UAE have multiple companies that has been operating. UAE corporate tax allows you to combine all of these as a one single entity, thereby reducing the compliance cost, allowing you to set up the losses, taking you out of the ambit of transfer pricing. So a person having 50 companies in mainland can group it together as one entity subject to 95% of the shareholding remains or the voting right remains the same. Now, very critical to note is, can a mainland and free zone entity club? Unfortunately, you cannot club them. They will be treated as two separate tax groups, but this is a major relief for a lot of businesses that were working. Obviously, the tax losses remains the same. The conditions is 75%, and you can transfer the tax losses for a subsidiary or the other group companies as well. Moving ahead to the corporate tax liabilities and credits that will be available. On the net income, as I mentioned earlier, you on the income up till 375,000 dirhams, there is 0% corporate tax. Over and above 375,000, there is 9% tax, from which you can always deduct the foreign tax credit, but up to a maximum of UAE corporate tax payable on that foreign sourced income. It cannot exceed the UAE corporate tax on amount. Moving ahead with the basic withholding taxes, as already communicated, it is as on date, it is kept at 0%. The withholding tax remains 0%. So there will be no major implications. And then to the basic administrations and how you all should be ready for the UAE corporate tax. The first thing that you should start doing from today itself is you need to get registered for the corporate tax, whether you are taxable or exempt, right? Second, you also need to start maintaining the financial records. You need to also make sure that the penalties and violations that were happening till date should not continue, to avoid any future penalties and violations. So any taxable person, all the taxable persons have to register. They can always deregister if the business is not continued. Financial records have to be maintained for 7 years. And if there is any non-filing or any other liability that is there, penalties and violations of this will, you will be fined and penalties will be applicable, but the same has not been decided, which will be expected later. Moving ahead to the filing due dates, as per the businesses, if your business calendar is July to June, your first filing return will be 31st March 2025. If you follow a Jan to December calendar, it will be 30th September 2025. And if it is an April to March calendar, your filing due date will be 31st December 2025. With this, I end the topic on the calculation of income. I hope it was clear, simple, and I am sure over to Sheetal sir for few poll questions that we have for the audience.
Thank you, Pratik. Very well explained and at the same time very swift. I'm sure I could sense from the previous polls that we had, the understanding is quite impressive amongst our audience. So let us launch a few more polls on the topics that you have covered, Darpana.
Yeah.
I know certain hands are raised. So let us complete our polls, and certain queries has been raised as well, which you can type in the chat box as well. So we'll try to take them after the polls.
Okay, here's the first one.
Interesting. While I think this was also one of the first question raised in the webinar in this chat box. And this will answer that. While calculating taxable income, can I deduct all business and personal expenses from my business revenue? Three options: only business expense, only personal expense, or both. Wow, there are 3% people still thinking that they will be able to claim both. Unfortunately, only business related expenses will be able to claim as part of the deductions while calculating taxable income. Any personal expenses cannot be claimed. But there are a few hopeful people. Let's launch our next poll. This is in my business, I have a positive EBITDA. However, net profit is almost nil due to significant interest cost burden on my business. Do I still need to pay UACT? We have Pratik has just covered interest capping rules. That interest is only allowed up to 30% of the EBITDA to be deducted out of your taxable income. So do you think what is the answer? No or possibly yes? True. Yeah, 8% of the people still think that 100% of the interest can potentially be claimed as an expense, which is not true. The law restricts only 30% of your EBITDA. To that extent, interest expense can be deducted. If your interest expense is more than the 30% of your EBITDA, there are provisions to carry forward up to 10 years of unclaimed interest, which has not been able to be deducted. However, but for that particular year, you can only claim up to 30% of the EBITDA. 92% are still correct. Next one. Can I file one single UACT return for all the companies that I own in UAE? Yes, if I choose to form one single tax group meeting all the conditions. No. What do you think? Yeah, so there is a provision in the law that talks about tax grouping. However, certain kinds of companies cannot be part of the tax grouping, which is the qualifying free zone entities cannot be part of the tax grouping, or any foreign entities cannot be part of the tax grouping. But you can make tax grouping for all the eligible entities and file one single tax return. There are certain conditions that is listed in the slides as well, which we will share with you. But yes, the law takes care of this. Next one. My family owns and control multiple companies, and there are intra-group transactions, including intra-group company loans. Do I need to comply with transfer pricing rules? Yes. Option B, no, if the tax group is formed, or both above. Which is the right answer? You need to see it carefully. My family owns and control multiple companies, and there are intra-group transactions, including intra-group company loans, which is possible. I know number of clients who owns multiple companies, different businesses, and there are transactions between those businesses, including intergroup loans. Do I need to comply with transfer pricing rules? Option A, yes. Option B, no, if the tax group is formed. And option C is both above is correct answer. See the results. Wow, this is the mixed results. 51% people think that yes is the answer, transfer pricing rule. 16% people know if the tax group is formed, they don't need to comply with the transfer pricing rules. And both above. Excellent. I think the answer is C. What do you say, Pratik?
Sir, I agree. It you have that probability, right? When you form a single tax group, it will be out of the purview of transfer pricing. So
correct.
Yes, the answer will be
answer B is correct. Answer A is correct if the transfer pricing, if the group is not formed.
Not formed.
Right. And answer C is, it becomes correct because A and B are correct.
Correct.
So the correct answer in this case is C, both above. I hope it is clear. Let's move to the next one. This was tricky question, by the way. Yeah. Wow, this is a heavy question, right? So I own 10 companies and we qualified to form a single tax group for all the companies. Do we get benefit of 0% tax on up to only 375,000 dirhams for the whole group, or the 0% threshold will increase to 3.75 million, which is 375,000 multiplied by 10 companies for that particular tax group? See, there is an exemption limit per entity of 375,000 dirhams. We all know exemption in the sense that 0% tax rate. So if 10 companies come together and form a tax group, do they get 10 times the benefit, or they don't get that particular benefit? So the option A is the limit for the whole group remains to 375. The option B is limit increases to 3.75 million, which is 10 times 375,000 dirhams. I hope we have been able to frame the question as clear as possible. I would like to get to the answer of it now. What is the answer? Yeah, 87-13. 87% people think that the limit will remain 375. 13% people feel it is unfair if it remains 375. They wish for 3.75 million. Yeah. Unfortunately for the 13% audience here, the limit will remain only till 375,000 dirhams. However, you get benefit of tax group set off of losses, seamless set off of losses between the tax group. Yeah, moving on to the next one. Do I need to register my company with FTA for UACT even if my company is dormant with no business transactions for the financial year? This is simple question. 3% people still feel that they don't need to register with FTA if their company is dormant. No, unfortunately, the law requires every single company in UAE, free zone, offshore, dormant, working, thriving, all kind of companies to register under UACT law. Going to the next one. Do I need to register my company with UACT separately even if I already registered for VAT? This should be straightforward. %100. Wonderful. So we all are aware that VAT, the same authority, Federal Tax Authority, will look after VAT as well as corporate taxation. However, there will be a separate registration required for corporate tax vis-a-vis VAT. This is well answered. Next one, Darpana. This is a good question, funny question. Are there any consequences of not complying with UAE corporate tax laws? Simple, straightforward. Yes, 100% people think that government will go after them. There will be consequences. Excellent. Going to the last one. This is on a lighter note. In fact, these questions are on lighter note, it seems. Yes. Yes, 100% people think that government will go after them. There will be consequences. Darpana? How often I need to file UACT return? This is good. Annually, quarterly, or quarterly as well as annually? Both. Wow. There are few people who think that corporate tax return has to be filed on quarterly basis along with annually.
4%.
Yeah. Still there are few people, but what I see, corporate tax return, unlike VAT, is an annual return filing. So there is no quarterly obligation on it, nor there are any provisions for advanced taxes that we have, in some of the jurisdictions that we all belongs to, like India and other parts of the world. Here it's annual return filing, and without any advanced taxes to be deposited as well. Go to the next one. Yeah, this is good one. Huh? I deal in various currencies. In which currency I need to file UACT return? I think Darpana, the first option was USD being widely global accepted currency, AED, or both? The first option was actually now merged in the question itself. Anyway, The question is, I deal in various currencies. In which currency I need to file UAE city return? Three options. USD being widely accepted global currency, AED, or both. What do you guys think? I think we made it easy because of the error in typing the question. But let's see the answers. AED, 100% AED. So everyone is clear, no matter what, which is the global currency, widely accepted global currency. We are in UAE, it's a UAE law. We have to file all our returns in AED terms. How to convert all your foreign exchange, foreign currencies into AED? They have also shared in the law that it will be according to the rates published by UAE Central Bank. Going to the next one.
So that's all for today. We can go with the audience questions right now. We have a couple of those from the chat as well. I can ask those like one or two from the chat, and then if people want to ask questions, just raise your hand. I can unmute for them.
Excellent. So let's go for some of the questions that we have received.
Sir, can I take it? Can I read the question?
Yeah, there was one question, I found it very interesting. Gustavo Montreal has raised a question that can I pay full profit as bonus to myself by year end? Hence, no taxation because personal income is not taxed. Pratik, you want to take this?
So, I think he was not there for the transfer pricing things, I think, and he missed a few certain areas. But as covered, if you are running a business and if you're drawing salaries or remuneration, if it is not at arm's length, you will be still under the purview of corporate tax, unfortunately.
See, this is a bit of a subjective area. And unfortunately, in the law also, they have kept it very subjective even now. Any transactions between related parties and connected person. The law uses the two terms, related party and connected person. Related parties are going up to four kins, four level of kins, which includes great grandfathers, your your parents, your siblings, your cousins, your uncle and aunt, which is both mama and chacha and mama, mami and chacha, chachi. Your, so it is
your parents, uncle and aunt.
Your parents, uncle and aunt. So I think it is going to very wide definition of related parties. And also connected person are also quite wide. If you have in your company, for example, an employee, uh, uh, he becomes a connected person and his family members becomes also a connected person. So all transactions, and in case of juridical person, which is entities, control and 50% and above ownership is the criteria. If you control it, if you have 50% and above ownership, or if you have 50% and above voting rights, all those entities are part of the related parties. And all the transactions with the related parties has to pass through the transfer pricing rules, which includes, which as in essence is an arm's length dealing principle. For example, till last year, you were drawing a salary from your company, say 30,000 dirhams, and from this year you increase to 100,000 dirhams just because to sweep your profits from the company, which will be taxable if not swept, and claim it as a personal income. I don't think it might pass through the test of transfer pricing. So I think we need to be mindful of it. And not only that, for example, if your wife owns a company, not you, and you are just an employee in the company, even in that case, you are connected person, right?
Correct.
So your income that you can charge as part of the salary, or will have to pass through the transfer pricing and the arm's length principle. And that applies to, in my view, across the spectrum, even board of directors taking their fees from the companies, where they are board of directors, they automatically become related parties or connected people. So I think this is I hope this answers this question.
There's
Okay,
one
there is one
question.
more. Yeah,
Okay.
sorry. No, I just noted two good questions, and after that, I give it to you,
Yeah.
Darpana, to ask, because after that, I couldn't note it. One of our guests, Hassan, he has asked a question. Hello, for sale of goods, buyers and sellers are outside UAE only. The collection of money is at UAE bank. Do we have to pay tax? We are a LLC company working like offshore. Sales are outside UAE and goods doesn't enter UAE. Only the collection from customer and payments to supplier go from UAE. See, I'll repeat this question for the benefit of our audience. It's a heavy question, a bit. For sale of goods, buyers and sellers are outside UAE. Many of entities in UAE are engaged in global trade. So they buy from somewhere else, sell to some other country. Only the collection of money is in UAE. That is also taken. Do we have to pay tax? We are an LLC company. This is an important point. Is an LLC company working like an offshore company. Sales are outside UAE. Goods doesn't enter UAE. Only the collection from customer and payments to supplier goes from UAE. Karishma, you want to take this?
Yes, sir, sure. Am I audible?
Yeah, audible.
Yes. Uh, so if a person is having the exports of goods or services and the income is just booked, as of now, the free zone persons who are there, if they are just having the income from export, then that won't be taxable. But if the company is registered in mainland, then their global income will come and that will be taxable. So this is the gist. And considering the question that person has asked, so I would like to say him that if he's in free zone, then his income that is he's generating from the export of goods or services, it won't come under the corporate tax. But if he's in mainland, then that will be taxable.
The only thing that I would want to add here is again the concept of permanent establishment is and substance is also equally important to
Pratik sir,
get.
you're on mute.
Pratik, I can hear. Pratik, I can hear. Yeah.
Yeah, sir, please.
No, I see, first and foremost, answering this particular question, I feel it's a LLC company. LLC company, global income will be taxed. This is very clear. However, there are, I am hoping that there are, as the legislations may come out, as the, further clarifications will come out, particularly when it comes to qualifying free zones and qualifying income. In that case, free zone entities might get the benefit of this international trade, which is not touching the shores of UAE. So we hope that that may fall under the qualifying income, related to the qualifying free zone, which will be out of the scope of, UAE. But in this particular case for Mr. Hassan, unfortunately, since he is doing it through an LLC company's global income will be taxed.
Correct.
Yeah. Yeah, Darpana, now you can ask.
So there's one is loss on net input tax credit or unclaimable VAT input is deductible as expense.
I think we had covered before. Pratik, you want to take this?
Revocable and irrevocable. Right?
Irrecoverable. Irrecoverable VAT.
Yeah. Correct. Irrecoverable VAT can be claimed as deduction. And that is as per the current law, it is very clear that any input tax that has been paid cannot be claimed, but recoverable VAT can be claimed.
I think that's that's clarified in the
Correct.
documents. Yeah.
I would quickly want to touch upon because I saw a small question on small business reliefs as well. So businesses, small business relief yet has not been defined. However, there will be a definition that is expected, which will clarify the definition for these small, businesses and entrepreneurs, specifically startups. Based on that, the clarity can be expected whether you have to register for CT. But as on date, it is clear that if you do not fall into the government entity's definition, you have to get registered for corporate tax.
Okay, there's one more by me, Sri Narivasa Rao. What are provisions related to family foundations?
Srinivasaji, good to see you. Thank you for asking this. Yeah, we have covered family foundations. Family foundations, Pratik, you want to take it? Since you
So
covered this topic, yeah, please.
I think Karishma covered it, but I will quickly add
Uh,
with Karishma here. So family foundations, if they're doing business, are definitely under the purview of corporate tax. But if they're just holding, the assets, and if it is a family trust without any business, it can definitely be out of the scope of corporate tax.
however, however, they have to apply
That is,
to
yes.
FTA. They don't automatically get out of the preview. They have to apply and and seek the permission. And the conditions are also specified very clearly that they should be working like a just a pass-through entity, like an unincorporated partnerships. So for they should be only doing the activities of holding assets, collecting the income and distributing to the beneficiaries. So as long as they are and they are under registered in UAE under regulatory environment. So if these things are met, you can claim an exemption and exemption will be granted.
So
Just one more.
two small questions that I can quickly take is how about registering for corporate tax? When will it start? What are the conditions, limitations? Are you expecting your audience to become tax experts? So, for all of this, I think we need to understand that you need to register for sure. But from 1st June 2023, you will have to maintain your books of accounts, and for which you will need tax advisors and your consultants whom you already are working with to help you out with the basics. You need to register, you need to maintain your books of accounts, you need to also apply, and you need to take care that any losses till December 2023 are not carried forward. So all of those small things you need to start taking care of. Plus audit of this financial year is, like someone asked, is the audit compulsory for a previous year? So for that, to the best of my understanding, audit for previous year is not required. However, from 1st June 2023, the window will be applicable, and audit, if applicable, has to be done mandatorily. Sir, if you want to add something.
Yeah, no, I'll add something. The law doesn't say audit is required mandatorily. Law says proper books of accounts to be maintained and for 7 years. And if the authority asks for financial statements,
Financials.
you need to submit it. However, they may ask for certain entities for audited financial statements as well. So it is drafted in a way that automatically you're not there, by default it is not a mandatory, but it can be asked anytime. So you want to wait till the tax officer comes and knocks your door, or you want to prepare ahead of it, is something they've left it on our wisdom. Yeah. So any other important question here?
There's one from Manmohan. My financial year is ending December. Tax is effective from 1st June 2023. As per my understanding, I will be filing tax return for the financial year ending December 2024. What about income for the period July 2023 to December 2023 as partial year?
Can you repeat this again?
So it's my financial year is ending December. Tax is effective from 1st July 2023. As per my understanding, I will be filing tax return for the financial year ending December 2024. What about income for the period July 2023 to December 2023 as partial year?
Excellent question. Karishma.
Yes, sir, sure. So, Mr. Manu, I would like to tell you that as
Yeah, go ahead, Karishma.
yes, sorry. So, Mr. Manmohan, your income that you have earned for the period of July 23 to December 23, it won't come under the purview of corporate tax. Although you have to maintain your books, you can do that, but that income will not be subject to corporate tax. Your corporate tax will be effective from 1st Jan 2024 to December 24, and for that period only your eligibility criteria of taxable income of 375,000 dirhams that will be calculated, and you have to pay tax on if your income is exceeding that limit for Jan 24 to December 24. So for this period, there won't be any tax and it will be not be considered as your taxable income as well. I hope that clarifies your question, Mr. Mohammed. Mr. Man, sorry.
Peter sir, you're on mute.
No, I'm saying interestingly, we are given certain time period and flexibility to plan for corporate tax implementation on our businesses, and they're not disturbing the mid-year aspect of it. So it will be applicable from the financial year which we have chosen. It's a choice that is given to us, although they are by default saying calendar year, the Georgian calendar year, but we can choose the financial year which we want to apply on our business. And the first financial year that we choose, well, it can be 1st July to June, it can be October to September, or it can be from January to December, but any first financial year falling after 1st June 23. So you are effectively, for you, the corporate tax will be applicable from Jan 24. So that's a good for you, right? You get seven more months.
We have a couple of hands raised in the participant.
Before that, Darpana, there's a last question that I want to, ask to even Sheetal sir and Karishma. Piyush has asked this question: since global income of an entity controlled and managed from mainland is taxable, whether the free zone, I assume it is qualifying free zone income, or is also taxable, is the question that Piyush has asked.
Since global income of an entity managed and controlled from mainland is taxable, whether free zone income also becomes taxable. Yeah, interesting question. See, if an entity is a free zone entity, there they have, unfortunately, I mean, and interestingly as well, they were very vocal when the public consultation document came. In public consultation document, there were very few examples also were given wherein there were even within the free zones they have defined between designated free zone versus non-designated free zone, and the distinctive advantage designated free zone had in comparison to non-designated free zone. In the law which we have today, they have not done anything except giving two definitions, which is qualifying free zones and qualifying income of the qualifying free zones. So we have to wait until those definitions get clarified by the legislations. Until that comes in, Unfortunately, we cannot say, but yes, we feel that, if we assume, what was there in the public consultation document, any foreign related income for a free zone entity and any transaction between free zone to free zone will be outside the preview of the corporate tax. Services is a tricky area, because mainland source income, which they in the law defines as state source income, right, includes any income which you derive from a resident person. So if I am a free zone entity and I am providing, say consulting services to another free zone entity, which is for the purpose of the tax law, is a state source, is a resident taxable person. I strongly feel that will come under the preview of corporate taxation. However, if there is an export of services to a foreign entity, that might not be still subject to definition of qualifying free zone and qualifying income, that might be outside the preview. Hope this answers, Piyush.
Darpana, over to you.
Yeah, we have Mr. Ganpat in the queue. I'll just unmute.
Sir, good to see you.
Mr. Ganpat, you can unmute yourself and ask question.
Ganpat sir, very good to see you, sir.
Sitalji, can you listen to me now?
Yes,
Yeah.
yes.
Okay. See, as I understand that only a judicial person, that is a corporate, can only form a group if they are holding more than 95% in two companies.
Correct.
So, if a natural person is holding more than 95% in two companies, then as per that 75% rule, they can set off the losses or of each other. But in that case, whether transfer pricing rules shall be applicable for.
Yes, sir. Transfer pricing
will be
rule will be applicable because they automatically become related parties.
Yeah.
The related party definition, is, I was reading it again and again, and last night also I was reading it. It was quite, quite a vast definition. I mean, in today's generation, where in nuclear families, we don't know who is my father's uncle's and what is his name, but
Yeah.
he's also covered in it.
Yeah.
So, unfortunately, yes. So we have to be careful, we have to be mindful, and at the same time, prepare for it. That's the only thing that we can do in this case.
Okay. So, but if a corporate is holding the 95% share in the two companies, still the transfer pricing shall applicable between that tax group company?
Thank you for asking this question. Once you form a tax group, transfer pricing goes off.
Yes.
Because then you are consolidating this whole thing. Because then you are eliminating intergroup transactions anyway.
So it means the answer is you should form a tax group holding company rather than a
You
natural.
can make a holding company and then automatically transfer pricing issues goes off.
Okay. Thank you.
And consolidate it and ask for the tax grouping, because we need to ask for the tax grouping, apply for that tax grouping.
That's right. Yeah.
Yeah.
Thank you, Sitalji. Thank you.
Thank you, sir. Thank you. Good to see you.
Yeah.
Aftab ji,
Kwan?
Aftab ji, Piyush, Payman, Manohar ji, Lalan ji, and Sohan. There are 7 people who are.
How much time we have more?
I think we'll quickly, take one or two
quickly
questions.
have 10. Yeah, for 3-4 questions we can take. Yeah.
I have unmuted for Mr. Aftab. Mr. Aftab, do you have a question?
Aftab ji, you can unmute yourself and ask the question. Let's go to Payman ji.
Have you unmuted Payman?
Yes,
Payman, good to
Payman.
see you.
Hello, you hear me?
Yes, yes, yes. Good to see
How are
you.
you doing, Shital?
I am very good. I hope you were there when we were covering foundation.
Yeah, I'm just, I was trying to catch up. Karishma, it was very fast.
I
So,
saw your comment. Yeah, please go ahead.
okay, fast forward. I just wanted to know that regarding the goods buy and sell. Let's say like this, that I have two companies. One is Shams Free Zone, but it's mentioned that LLC. So I don't know the definition of that. Basically, Shams Free Zone is not have designation area, so it's look like the mainland. So
Go ahead. Go ahead.
yeah,
Sorry.
another company we have in the Ajman Free Zone that has the designation area. But the point is that if the but they are all under the one tax group. So if the company in the free zone, which is Ajman Free Zone, buy and sell something outside of the UAE and then collect the cash inside the UAE, what is the scenario?
Yeah. So again, uh, both are free zone, as I understand from you.
Yes.
Now, I really hope I really wish that I could answer your question, with absolute clarity.
Yeah.
However, so far what has been out, with the law that is published,
Right.
there are two things which we have just mentioned, also just 5 minutes back. There is something called qualifying free zone and qualifying income.
Right.
And they
I
have
got it.
just mentioned that qualifying free zones, qualifying income will not be subject to UACT. However, the definition of qualifying free zone is not yet clarified. Which are those free zones, on what conditions, and all that. This will come in clarifying notes, which we are anticipating any time. But until then, we really hope that most of the free zones falls under the qualifying free zone. That's one. And any business that you are doing between two free zone entities, falls under the qualifying income. So if it passes these two tests, then you can sleep well. And if it doesn't passes these two tests, then you have to pay 9% to sleep well.
No, still we will sleep well, right? We will open another company in the qualified free zone. It's just a matter of opening another company. You know what I mean?
That's tax planning.
Thank you. Thank you. Thank you.
You're welcome.
Can we have Lalanji and Sohan? We have only two people, so let's quickly Darpana do it. You're on mute.
Lalanji, you can unmute yourself and ask a question.
Lalanji, you can unmute. Yeah.
Hello. Yeah. Mr. Sheetal and Mr. Batik, thank you so much for this session. Actually, because I'm attending from office, so even though I kept the reminder, but I forgot to join. So now I'm eager to receive the presentation and the video recording on my email.
Sure.
We will
Sure.
we will
So I
share.
would like for the larger audience, I would like to also inform that you can follow us on YouTube on MI Capital. The recording will be there. However, we will formally drop an email as well.
Okay. Yeah. Thank you. Thank you so much.
Thank you.
Thank
So
you.
when will be the next session, or this is just as a first and final?
Yeah, this is the first of the series of sessions that we are tomorrow we are. I don't know where is your office, but tomorrow we are doing a session at JLT.
JLT.
Okay.
At Astrolabs. So
Okay.
along with Astrolabs, so you can if I don't know where is your office.
My office here in World Trade Center.
Yeah, if
So
you
you can
wish,
attend.
you can come to JLT at Astrolabs Cluster R.
Okay. Yeah.
What time is it, Pratik, tomorrow?
5 p.m.
Yeah, 5
5
p.m.
p.m. Okay, okay. So what we are going to cover in this session?
Same,
Okay.
same.
Okay,
We'll
yeah.
cover
Thank you.
the understanding of the law. Yeah.
We're going to the next one. Avinash sir.
Hello,
Hello.
you
Yeah.
can hear me now? Yeah.
Yes.
Yeah.
Yeah. Hi, Sheetal sir. So my question is, we have a company in a free zone, and there is a company in India. The company in India is controlled by the spouse of the director, spouse's parents of the director. So
Hmm.
the director of the UAE entity and the Indian entity is being controlled by the his spouse parents. So is it
Correct.
related?
Unfortunately, yes.
Okay. So even spouse parents are covered in related party definition. Okay.
Yes. 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 So, but I mean, you need to maintain the arm's length transaction. I mean, as long as you maintain the arm's length transaction, there's nothing that stops you from doing it. It's just that you cannot undercharge, overcharge. That's it.
So we have to basically follow the transfer pricing. That's it. Nothing else.
Correct. Correct. Correct.
Okay. Okay. Thank you, sir.
We have two more people who have raised their hands. Should we go ahead?
Yeah. Yeah. Please, let's finish it off with this. The last,
Last two, yes,
last
the
two
last
questions.
two.
Mr. Darshan Kumar, I have unmuted you. You can unmute yourself and ask question.
Yeah, hi. Hello, Mr. Sittal. How are you?
Yeah. Hi, Darshan.
Yeah, my question is regarding anti-abusing rule. Can you please say something on that?
See, anti-abusing rule, the way it is drafted in the law, it gives immense power to the authorities. Wherever they feel that we are anybody is trying to avoid taxation, wherever they feel without going to the details of the provisions of rest of the law, wherever they may feel that the law and the provisions of the law are being abused in order to avoid taxation, they can do whatever they feel reasonable in that circumstances. This is the essence in a simple way that I am saying. So this is quite I would say vast in terms of the powers that they assume because of it. But again, I can really hope that those will not be applied quite frequently by the authorities, as long as there are clear provisions in the law, and as long as we also do the business in as per what is the latent and the purpose of the law is.
Okay, so it means we have to wait for the regulations to clarify on this
Not
one.
for
No,
anti-abuse
no.
law. No, 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 not for
Correct.
anti-abuse law. Anti-abuse law is very clear. I think it is saying that
Okay.
whatever is there in the law, if we feel that the law is being abused in order to avoid taxation, doing whatever you want to do, they can do whatever, they can do what they feel is appropriate.
Okay, so in other countries or like say suppose in India, there is a concept of tax planning and tax evasion, right? So tax evasion, it is not defined anywhere, right? In here in this law, federal law. So whether tax planning is also covered in this thing?
No, tax planning is
Tax
certainly one
planning
can
is
do.
correct.
Okay,
Certainly
okay,
one can do tax planning, but again,
okay.
if you are abusing the law, I mean, again, it is very subjective. You have to understand the intent of the law. The intent of the law is to tax certain set of income, correct, at certain rate. Now, if there are various methods that is being applied in order to avoid even that, right, then they will invoke something like this.
Okay, okay. Thank you, Mr.
The last one. Harshada.
Yeah. I've unmuted Harshada. You can ask your question.
Harshada, you can unmute and ask.
Hello.
Yeah, Harshada.
Yeah. Hi, Sheetal ji. Hi, Pratik, Karishma. This was really very good session and really simplified. I just have a question on this Article 15. We have the investment manager exemption. So I didn't see it being covered here. So we are basically investment managers in DIFC regulated by DFSA. So I wanted to know whether we are exempt specifically from by Article 15, or we need to apply for it, and whether this will be exempt for us.
Yeah, so as far as the investment manager is concerned, investment manager will be subject to tax, right?
Okay.
However, again, I go back to the same point. AIFC is a financial free zone, correct?
Mhm.
Now, qualifying free zone and qualifying income, we need to see that, right? But investment manager as such, investment fund, can be treated as a pass-through vehicle, right?
Hmm.
Not the investment manager. The 2% fee that you make as an investment manager, whatever fee, right?
Hmm.
Right, is subject to UAE because you are a UAE resident, you are earning this money in UAE, you are doing it as a business. That is a part of the UAE. And however, if there is a overlying factor that may come because of the qualifying free zone, and DIFC has declared a tax holiday already for its registered entities, and UAE law will also cover, will clarify whether that falls under the qualifying free zones and that particular income falls under the qualifying income, which we hope yes, then you will be out of the scope.
But
But
Sheetal ji, this Article 15 like clearly and distinctively exempting investment managers in UAE.
no,
So
in
if we
uh, no. I think there has been FAQs for this. I remember reading that, and
okay.
I will try to get you the exact provision of this from the FAQ.
Yeah,
But
because it says it's
the
engaged in the business of providing investment management. And then there are few other conditions. If those all are met, then it's the heading only says that investment manager exemption. So I was not very
Yeah.
sure what this
No, so
article is
the
for.
investment, I think the purpose there in that law, in that clause, is related to the investment manager who is not acting as a permanent establishment for a foreign entity, right?
Mm-hmm.
Who is having a discretionary investment mandate. In that case, it will be treated as a pass-through and will be exempt, right? This is for the fund. I think it is the purpose of that particular clause is related to fund. But in any case, if you share with your name and number,
Okay.
I think I will come back to you on that as well with specific points, because I know somewhere, I don't remember the clause yet,
Not
but
58 and 59. FAQ 58 and 59.
yeah, so I'll come back to you.
Okay. Okay. And sir, we have a parent company which is also an investment manager registered in Cayman. So
Control
it
from
is a
UAE.
100% parent of our DIFC entity. So will that be non-resident will be taxable here?
Controlled from UAE.
Yeah, more or less.
Then yes.
Like it's 100% owned by the owner. Like there's a common owners
Yeah,
for
so
both.
as long as UAE, it is managed and controlled from UAE. Since you mentioned Cayman, it is very clear, right? The total people living in Cayman is about 100,000, I think.
Yeah.
So, 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 so unfortunately, that may fall.
Okay, and then we can form a tax group with our parent, like because it was saying that the company in UAE having 95% in the other companies, but
Yes,
the UAE company is a subsidiary and the Cayman is the parent.
that does not says that the parent has to be UAE as well. I don't think
Okay,
so. Yeah. Yeah, so you can make a tax group as long as the common shareholding is there, 95% shareholding.
Okay. Okay. Thank you so much, sir.
Yeah,
How do I pass on
coming-
my details?
Yeah, you can pass on. You can write down here so that we will take a
So
note of it.
Harshada, if you have registered, we would have your email. You have registered?
Yeah, I registered.
So we have your email IDs and mobile number. We'll reach out to you.
Can we
Okay.
take the full name?
Harshita Pauti.
Harshada.
Harshita?
Pawate.
Yeah.
Okay. Okay. Interesting question,
Again,
Harshita. Thank you.
yeah. Again, thank you all of you. So
Thank you.
That's all for today. So you want to?
We have okay, that's all. We have
Yeah.
one poll now. Darpana, can you launch that poll? Or shall I read it?
Yeah, you can go ahead and read it.
Okay. So now there is a poll, and you may unmute people, or people can type in the chat box as well. What should I be doing to prepare for UACT? Sit and do nothing, option A, and understand its impacts on my business and plan for efficient compliance. What do you think? We can unmute and hear everyone's views about it.
2 hour session is too long. Concentration declines.
Plan. So at least we have one answer here. Plan for it. So,
Harshada
so
also says the same.
thank you very much, everyone, for attending. I truly appreciate your patience. Yes, 2 hour session is quite a long session, but I see still, a lot of people in the webinar. Thanks a lot. Do share your comments to us on our social media, YouTube,